Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Fantastic panel for you. Steve Ricchiuto of Mizuho, David Kelly of JPMorgan Asset Management alongside us. David, first to you, your view on this inflation data of the last 5 minutes or so.
Yeah, I think it's okay. There are some bouncy numbers here. We got a 3.6% increase in airline fares. That contributed to it. We got a 0.6 increase in apparel, which was down 0.7 the prior month. So it's bouncing around. But I think the big picture here is it's kind of like when you take cookies out of the oven. They're cooling, but they seem to be cooling really slowly. And you want that inflation rate to come down faster. And it is coming down. But it's going to take some time, and that's okay. But I don't think there's anything here to alarm the Fed or anybody else. Some of the things that bounce month to month bounced higher in February, and that's why you got this number.
David, just to extend this one step further, is eating the cookie cutting interest rates? Is that what that is?
Yeah, but it's probably, too many cookies are not good for you. So I'm not looking for a very fast reduction in interest rates, and that's okay. I just want to see this expansion stretch out, and if the inflation rate can slowly cool, that's really the best for the economy and for investors.
There's a question, just to continue the analogy, Steve Ricchiuto. If you leave the pan of cookies on the oven and the oven is still on, do they cool at all? And that is really a key question, essentially, if we're dealing with a lot of these different factors that still are sticky and going and coming, but if you don't have some sort of ongoing tight policy, do they cool at all?
Well, the reality, fundamentally, it all comes down to the labor market at the end of the day. I hate to bring it back to last week's economic statistics, but it really does. The result is that most of the components in inflation that are not going down are components that are service-related, therefore they're income-based, and that's an important driver. And as long as we have an economy that is running with this tight a labor market, and 3.9% up from 3.7, oh, that sounds like a really big move. It's really not a big move. We're still well below the natural rate of unemployment, which means the frictional level of unemployment in the economy. This is a tight labor market, and it's not generating the easing of the labor market conditions that could say to you, inflation's definitely going to go back to 2%. And I think at the end of the day, the reason why you have a market that's looking through this number that came in hotter than expected is because the Fed's telling you they want to cut rates. So they're not telling you, well, we're looking to see whether we have to raise rates or we have to cut rates. They're telling you we want to cut rates. The problem is the data is not letting them. And this has been the driving force behind our call all year. And we began it last year in November that they probably weren't going to be given the opportunity in 2024 because the economy is not going to give them the opportunity. And that continues to be the underlying thought process here. And this data just kind of pans it out.
This is what makes your call really, really compelling. As you say, you are fighting the Federal Reserve.
Well, I'm not. The Federal Reserve is fighting the economy. That's the difference. I'm not fighting the Fed. I'm not fighting the economy. They're fighting the economy. And I hate to tell you, fighting the American consumer is a losing battle. And that's what we're running into. This American consumer, they have a tight labor market, they have income gains, and they're going to spend it. There's liquidity. People are willing to lend them money. They're going to spend money. And that's the Energizer bunny of the U.S. economy, is the U.S. consumer.
David, I heard your voice as you tried to interject, so go for it.
Well, yeah, with all due respect, I do slightly disagree with this whole idea that we're getting inflation coming or significant inflation coming out of the labor market. It is still a tight labor market, yes. But even in this report today, one of the key variables I look at is food away from home. What are restaurant meals doing? Because that is very sensitive to wages, and they were only up 0.1%. Also, if you look at last Friday, look at the labour market data in general, the quits rate is now down to 2019 levels. So people are not quitting in huge numbers. If you look at the National Federation of Independent Business survey of owners, the number of small businesses that say they're going to raise wages is now at its lowest level since March of 2021. So we're not seeing those wage increases. Yes, it's a tight labour market, but we've got a lot of low wage immigrants coming into the labour market, which I think are holding that wage growth down. And I don't see a spread of wages in this report. What I see is auto insurance up 20.6% still. That's pushing up the measured CPI inflation rate. We've got shelter costs up 6% year over year still. That's pushing up the measured CPI inflation rate. But both of those numbers are lacking reality. And so what I think is going to happen over the course of this year is, yes, inflation is going to come down slowly. And I think that's fast. I think that will be fast enough for the Fed to start cutting in June, because we still do have a demonstrably tight monetary policy given the direction of inflation, and we ought to try to move back to neutral.
Steve?
Yeah, well, I think when we go in and start looking at individual components of an index, we're making huge mistakes. This is the point I think Lisa was talking about earlier. This is an index. It has components that are going to move up and components that are going to move down. That's why we use an index. That's why we just don't look at individual components. We look at the broad index. And the broad index is telling you a message. Inflation's sticky. We can argue and say, oh, this month this did this month this did this. But the reality of the situation is the index is not doing what they want it to do. So general price movements aren't doing what they want to do. And they're doing it because of the labor market. And this concept about the quit rates and everything else, we don't have enough historical data of the JOLTS data to make any really valid statistical commentary off the JOLTS data. It doesn't exist far enough back. And we're jumping on these Nouvelle statistics just like we did during COVID when we were looking at all these things about, how many people were booking restaurants, how many people were going to, taking out a DoorDash and things like that. And they all led us absolutely nowhere. The reality is the index is not going down anymore. It's stalling out. The core numbers seem to be leveling out as well. That's telling us that we still have a tight labor market. And on average, that labor market is generating enough consumer activity to keep this economy going and to keep inflation from coming back to the Fed's target as quickly as they would like it to be, because they're promising to cut rates. And the reality is the economy's not giving them the opportunity. And that's the real driving point.
David Kelly, I'm sure you want to jump back in.
Well, yeah, I do think, even with the JOLTS data, we've got a lot of data. You do have to put together a mosaic of all these data. I do think it's a mistake to use sort of rules of thumb or how the economy would have operated 20 or 30 or 40 years ago. The truth is this is not your grandfather's economy. It is not inflation prone. Inflation went up a lot. It's coming down. And even on, looking beneath the surface in the index, I agree if these were small categories. But that auto insurance issue is adding 0.6% to the overall CPI inflation rate. Which, we would be at a 2.6 instead of a 3.2 if it wasn't for the auto insurance issue. And again, the shelter issue is also actually more than 50% of the year-over-year inflation rate. So these two things, the way the government is mismeasuring shelter and the way it's mismeasuring auto insurance, if those two things fall out gradually of the CPI numbers over the course of this year, that CPI inflation rate will move down towards 2% unless we have an energy shock. So I think we're still, I still think it's cooling. I think somebody shut the oven off. These cookies are cooling. They're just cooling slowly.
Well, let me just deal with the auto insurance issue, because one of the reasons why auto insurance rates are going up is because when you get a fender bender today, it's awfully expensive to repair the car. Okay? There's a lot more in fenders these days than there used to be in fenders. So the reality is the costs are measuring what's in reality happening. It's not a spurious uptick. That's number one. Number two, when people get into arguing about, the rent-to-shelter doesn't do this or it doesn't do that, the reality is this is the index we have. Let's not talking about, can I get a perfect index? This is the index we have. This is the index we're setting policy on. This is the message that's coming across. The BLS does a very good job at trying to measure these things and measuring them as accurately as possible. And I think all of this second guessing as to what the data is doing undermines the real reality of the situation and keeps people hoping for something that's not happening. This is exactly what the Federal Reserve wants to have happen. They want everybody to keep on hoping that it's going to happen, so it keeps markets in, it keeps the labor market tight, and they hope they get an increase in social welfare. And that's what I think is the driving motivation behind this. And that's the reason why the equity market is up. Let's be honest. You have an economy here where the Federal Reserve is saying, we're not going to upset the apple cart. We're going to keep this economy moving. We're going to keep it going in a forward direction, and that's good for stocks. So it's no surprise to me that the equity market's doing what it's doing. Yep. The corollary is the bond market, on the other hand, is taking the assumption that we're going to get back to 2% inflation. And when people say, this isn't your grandfather's economy or whatever, and we're not getting back to double-digit inflation, the reality is if we're talking a big difference between 2% and 3% inflation, we're talking 100 basis points on the 10-year note. That's huge. And therefore, we can't discount the fact that we're getting stuck around 3, not around 2.
David Kelly, let's talk about the Federal Reserve. Governor Waller, what's the rush? President Kashkari, why do anything? You've got an answer to that. David, what is the answer?
Well, I think the answer is, to be honest, the Federal Reserve should not be trying to micromanage aggregate demand in the economy. If we've got a federal funds rate between 5.25% and 5.5%, that is a tight policy. It is designed to slow the economy down. It can cause, it's given us an inverted yield curve. It's causing problems in the pricing of assets and in regional banks. I don't want the Fed to cut aggressively, but I think they should gradually move back to neutral if the inflation rate is heading towards 2%. And so I think they'd be right to start in June, cut again in September, cut again in December, take it easy, but bring rates back down to a neutral level, which I regard as being somewhere in the 3.5% to 4% range for the federal funds rate. But they ought to do that because there's no reason for them to be interfering with the economy, which is actually going in the right direction with inflation, in fact, heading towards where they wanted to go. And on the issue of auto insurance, I realize that auto insurance prices have gone up. I have to pay higher auto insurance too. My real issue is it's up 20.6% year over year now. And whether the government is measuring that wrong or correctly or incorrectly, I'd be willing to put money on the table that won't be up 20.6% a year from now. In fact, I wouldn't think it'd be up as half as much as that. So if it comes down over the course of this year, it's going to pull the CPI inflation rate down. So I do think that inflation is coming down. And if the economy is moving in the right direction, the Federal Reserve shouldn't have its hand on the tiller either way. That's why they should move back to neutral. Which
raises this question, David. Before we go to Steve, I am curious, though, about the oven and the cookies, just because there is a sense that if you have easier financial conditions, as we see today in the market on the heels of a hotter than expected CPI print, that this will actually keep these multifaceted areas, continue to make them hot. Basically, the wall of money isn't going away because real wages are actually increasing. How do you fight against that idea?
Because we've had an economy which before the pandemic, before we had all this fiscal policy, we had an economy which was quite capable of producing low inflation. Yes, it's a tight labor market, but how many major strikes do we have occurring right now in the United States today? I think the answer is zero. We're not seeing a very vigorous labor force demanding high wage increases or they'll quit. And so I think you can actually run this economy relatively strong at high levels of capacity without generating higher inflation. And what's wrong with that? So I do think this is not an inflationary economy at its core. We got inflation because of the pandemic, the policy response in Ukraine. That's fading and has really faded. And because of that, I think inflation comes back down to 2% anyway.
This is fascinating, Steve, because ultimately this is one of the big disagreements. Are we entering a new normal, or is this going back to the old? Is that essentially the breach between yourself and David Kelly?
Well, there's this concept that because we were there before COVID, we're going to go back to there. Okay. It's a simple argument. The reality of the situation is the world we had before COVID had two very big differences. One, Larry Summers was talking about secular stagnation, okay, which clearly was not correct. Alan Blanchard, on the other hand, I think was 100% correct, talking about the fact that we had a debt overhang. Well, COVID corrected that debt overhang, okay? The federal government bailed out all the state and local governments. The lower interest rates allowed everybody to refi all of their mortgages and all their corporate debt at much lower levels of interest rates. Interest expenses are actually no problem for corporate America. That's a big difference there as well. The other fundamental difference that's taking place is before COVID, people were uncertain in their jobs. Okay? There was a high degree of uncertainty in employment. People were always convinced this whole concept of double-digit earnings, corporations making sure they managed towards earnings was going to bring down their employment. They could get fired any moment. Now there's a lot more security in your job. And when there's a lot more security in your job, it doesn't mean we're going to get accelerating inflation. The question is, does inflation come back from 3 to 2? There's a big difference between the two of them. And the big difference is not necessarily an equity consideration. It's a bond market consideration. Because fundamentally, where should the 10-year note be? The 10-year note should take the inflation target or the long-term outlook for inflation and add the underlying trend rate of growth to the economy. So if you have 2% inflation, you should have a 10-year trading range of 3.75 to 4.25. We're basically in the middle of that range right now. If it's 3% inflation, then it's 4.75 and 5.25. We're nowhere near that range. And this is the fundamental difference. And this is the problem for the Federal Reserve. They have a 2% target. Okay, they don't have a 3% target. They have a 2% target. Now, markets right now are allowing them to continue to be patient. At some point, the markets may say, we're not going to allow you to be patient. And that becomes the concern. When the bond market begins to turn around on them and say, you know what, we're not dealing with this, that you're going to get back to 2% inflation. That's the risk if they move. If they move and you wind up seeing the dollar go down dramatically, you could reverse a lot of the goods inflation, disinflation that has been taking place. And if that happens, they then have an inflation problem on their hands. And this is why they have to be patient, and they're probably going to have to be patient throughout the balance of this year. But it's not a negative equity story, because this Fed does not want to set this economy back. It's a positive equity story, and that's what's happening in equities. My consideration is the yield curve could stay inverted a lot longer. And just because the yield curve's inverted doesn't mean it's a problem for the economy, because nobody borrows at the front end of the curve anymore like they used to. And that's a critical differentiation.
You're asking a balance of risk question around the Federal Reserve, and I think it's an important question. David, help us answer it. The biggest risk right now, is it cutting too soon or holding too long? And why do you still believe it's holding too long?
Well, I don't think the biggest risk to the economy is actually the behavior of the Federal Reserve. I think they should, as a matter of long-term strategic policy, move back to a neutral rate because the economy doesn't need them to be tight at this point. But the bigger risks to the economy are really from outside of the behavior of the Federal Reserve anyway. Geopolitical risks, environmental risks. If something happens to oil, then our entire view of the world sort of changes a bit here. So I think the Fed ought to begin to cut. I think they will begin to cut. But my main point is that as we look at the data month by month, category by category. Now, we do build up to the pieces of the index because that's how we forecast. We have to look at the individual pieces. And what I see is a global economy, which is relatively sluggish. China is sluggish. Europe is sluggish. It's not generating enough demand to push up core goods or even food and energy in any way. So without some supply shock there, the whole goods part of the global economy is not going to give you inflation. I don't see a labor market that is particularly inflationary either. And so that allows you to come down to 2%.
Let's agree on one thing. We do this again next month. David Kelly, Steve Ricchiuto, to the two of you, thank you.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.